Welcome to the Stock Market Palantir. Today we are going to talk about CMCT. Creative Media and Community Trust Corporation is a company at a fascinating and I would say almost desperate turning point. We're discussing a distressed real estate investment trust, a REIT, that is undertaking a pretty radical strategic pivot, shedding its toxic lending division to focus solely on its core multifamily and creative office portfolio. This whole transition really culminated in November 2025 with the definitive announcement of a key asset sale.
And that is precisely where the financial tension arises. That crucial liquidity event occurred against a backdrop of, well, absolutely extreme market microstructure metrics. We are looking at a stock that, at the time of the sale, had a staggering short interest, a short float exceeding 60%, and borrowing costs surging past 600% annually. The question for sophisticated investors, it couldn't be clearer. Did the recent $31 million divestiture fundamentally de-risk CMCT and justify its long-term strategic pivot? Or does its extreme volatility signify that the stock price is purely governed by technical short squeeze mechanics, entirely divorced from its underlying real estate value?
Right. And I'm going to argue that the $31 million net cash injection, combined with this successful strategic realignment, provides a vital lifeline that fundamentally validates the improved outlook. The company is, I believe, actively moving toward operational stability by shedding liabilities.
And I will argue that given the severe history of dilution and those extreme market microstructure metrics, CMCT remains primarily a high-risk speculative vehicle, one driven entirely by technical forces that frankly overwhelm any fundamental signal the sale might otherwise have provided.
I see why you think that CMCT is just volatility, but let me give you a different perspective. CMCT is executing a decisive and, yes, painful shift that's necessary for survival and future growth. The sale of the lending division is a transformative liquidity event. We know from the definitive agreement that the transaction, valued at $44 million gross, yielded a crucial $31 million in net cash proceeds. Now, this is not a trivial amount for a microcap struggling with negative operational cash flow. Management has explicitly stated these proceeds are earmarked for two key areas. First, deleveraging, which continues the work they started with the repayment of the recourse credit facility in 2024. And second, funding capital expenditures for their primary growth segment, the multifamily portfolio.
I agree that $31 million provides a breath of air, but we have to ground this strategic shift in the harsh reality of the underlying operating performance. I'm sorry, but I just don't buy that the massive 66% price surge we saw in November was fundamentally justified by this cash injection alone. The underlying financials remain deeply negative. For Q3 2025, the company reported negative funds from operations, negative $11.1 million.
Could you briefly clarify for our listeners what FFO represents in this context?
Certainly. FFO, or funds from operations, is essentially the core operational cash flow metric for a REIT. A negative FFO of $11.1 million means that the underlying real estate portfolio, despite the strategic focus, is still burning significant cash every quarter just to operate, before accounting for many non-cash items. So when a stock exhibits the technical profile CMCT does, trading at a 600% borrow fee and a 60+% short float, it is structurally primed. A stock with a borrow rate that high is an economic time bomb for short sellers. Any rally under those conditions is purely mechanical, a forced covering event, not proportional to a fundamental change in intrinsic value.
But that mechanical volatility, as you call it, must have a catalyst. The $31 million injection is precisely that catalyst. It's not just about covering current losses. It addresses immediate, near-term liquidity risks. It allows for debt reduction, which in turn reduces the interest expense burden, a critical factor given the high-rate environment, which, we know from their preferred dividend disclosures references a federal funds rate between 4.33 and 5.33%. This cash buys them crucial time, a runway, to prove the efficacy of the pivot. And you can't dismiss the operational improvement either. Their focused multifamily segment showed relative strength, with net operating income, or NOI, increasing to $792,000 in Q3 2025. That indicates the strategic direction is sound, even if the overall FFO remains negative for now.
That's an interesting point about the NOI increase, though I would frame it differently. The $792,000 NOI gain in one segment is completely dwarfed by the overall Q3 net loss of $17.7 million. That $31 million is a short runway, perhaps 2 quarters of burn rate relief, not a permanent solution. And the company still has massive structural drags. For instance, they continue to declare and pay high-rate preferred stock dividends in the range of 6.83 to 7.83%? This preferred obligation acts as a permanent sizable cash outflow, a structural tax on the common equity that must be serviced before any common shareholder sees true value creation.
But the cash sale signaled more than just liquidity. It signaled a decisive break with the past. We saw the long-serving chief financial officer resign to join the buyer, effectively leaving the old troubled lending model behind. That C-suite change is an institutional signal of commitment to the new strategic vision.
Wait. Before you frame that as a positive sign of commitment, let's look at the optics here. The CFO is joining the company acquiring the toxic assets. To many investors, this looks less like a clean break and more like a high-level executive abandoning a ship that is still taking on water, even with the $31 million injection. If the new focus strategy was so robust, why would a senior finance leader transition to managing the very assets they just jettisoned? I struggle with that connection.
I think that's being overly cynical. Sometimes a clean break involves ensuring the asset transfer is smooth, and his expertise facilitates that. But let's shift focus slightly, because you keep bringing up the structural issues, and we absolutely must discuss the elephant in the room, the cumulative 1-for-250 reverse stock split executed earlier this year.
Precisely, and this brings us right back to the issue of shareholder trust, which the structural reorganization has utterly destroyed. The cumulative 1-for-250 split was a necessity to maintain NASDAQ compliance under Rule 5550A2 because the stock price had fallen so low. But think about the damage to investor cost basis. An investor who bought in at $5 pre-splits now needs the stock to hit $1,250 just to break even. These actions were purely administrative to avoid delisting, signaling profound underlying distress. And the need for a second, more severe split, a 1-for-25, just 3 months after the first 1-for-10, well, that just demonstrates market rejection and structural failure. This history creates institutional distrust that no single $31 million cash injection can overcome.
I sympathize entirely with the animosity. That cost basis shift is brutal for retail investors, creating what feels like an insurmountable hurdle. I get it. But you have to separate that retail pain and skepticism from the institutional necessity of maintaining NASDAQ access. I'm not convinced by that line of reasoning because while painful, maintaining the listing is step one to remain a going concern. Avoiding delisting is critical. Furthermore, transferring to the NASDAQ capital market provides necessary breathing room for the strategic pivot to take hold, giving them a longer fuse.
But the mechanism of the split is what matters here, not just the intent. This is the crucial link between fundamentals and technicals that I think you're overlooking. The 1-for-250 reverse split didn't just hurt long-term holders. It geometrically concentrated the short interest. It compressed the available public float, the shares readily tradable, into a minuscule number. This micro-float environment is the perfect structural setup for the volatility we saw. When you combine a minimal float with a 60+% short interest, any positive news, like the 31 million, turns the market into a tinderbox, regardless of the stock's true intrinsic valuation. The structure, not the news, drives that 66% move.
I agree that the structure magnifies the moves, but you cannot argue that the structure causes a positive move when the underlying news is negative, that the asset sale had fallen through. The short float would have crushed the stock to zero. The cash injection was the essential catalyst that provided the justification for a squeeze. The structure simply magnifies positive fundamental news, transforming what might have been a modest gain into a spectacular short covering frenzy.
That is a fair distinction, but I maintain the stock is purely defined by this powder keg dynamic. Let's focus on the mechanics of that borrow rate. When the cost to borrow is nearing 700%, as it has been, short sellers are forced to cover positions regardless of price sensitivity. It's simply an unsustainable cost of doing business. This extreme pressure explains the 66% surge purely as a technical squeeze exacerbated by low float and high fees. We are talking about pure mechanical market pressure overriding any kind of valuation model.
But doesn't the very existence of volatility, whether it's technical or fundamental, give management a survival tool they previously lacked?
How so?
Well, the existence of the at-the-market or ATM offering program confirms this. Management now possesses the ability to raise cash by selling shares directly into these dramatic, technically driven rallies. The volatility cuts both ways, as evidenced by the subsequent and equally sharp drop from the high of almost $8 back down to around $3.30 in late November. The fact that management has an ATM allows them to monetize that volatility for fundamental survival.
I come at it from a different way. The existence of the ATM suggests the company views these rallies primarily as capital-raising opportunities, not as indicators of stable, realized value. If management's focus is on utilizing technical spikes to fund their quarterly operational deficits, the cash burn we discussed, then the stock's role is confirmed as a mechanism for liquidity, not an indicator of investment stability. They are essentially selling shares at inflated, technically driven prices just to keep the lights on. That doesn't speak to long-term valuation confidence.
It speaks to necessity and execution. A management team that successfully raises capital to fund a strategic pivot, even by selling into volatility, is executing its mandate for survival. They chose a painful route, the reverse splits, to stay listed and access the capital markets, which enabled the ATM program. Now they are leveraging that access. While the $31 million injection is temporary, it bought the company the right to continue the fight, and the ATM provides them with an ongoing source of capital to fund the transition into the successful multifamily operator they aim to be. We must watch the NOI growth now to see if they can escape the structural gravity of the past.
I believe you are giving management too much credit for merely surviving administrative hurdles, the structural problems, the massive dilution, the destroyed cost basis, the extreme short pressure, and the persistent cash burn. They define this stock, and price discovery is also deeply opaque here. We know that 50 to 60% of the trading volume occurs off-exchange in these so-called dark pools. This massive off-exchange activity obscures true institutional depth and confirms that this is not a marketplace for fair valuation. It is a battleground for sophisticated arbitrageurs exploiting trapped shorts and low float. Until FFO reliably turns positive, CMCT will continue to be defined by high-risk, technical speculation, not underlying real estate value. The $31 million was a temporary ceasefire and a fundamentally failing business model.
But even arbitrageurs require a catalyst. The catalyst was the fundamental act of cleaning up the balance sheet and focusing the assets. Without that sale, the short pressure would have won. They have secured a vital lifeline by shedding the toxic elements of their past strategy. The $31 million injection provides the necessary runway to prove the thesis that the focused multifamily and creative office portfolio can overcome the negative FFO and reach operational stability.
And I maintain that the $31 million injection simply bought time within an inherently broken market structure. The recent price action is best understood through the mechanics of a short squeeze, driven by that extreme 60% short float and the exorbitant 600% plus borrow fees. We need multiple quarters of reliably positive FFO before we can credibly argue the fundamental value has decoupled from the technical chaos.
Right. We both agree that CMCT is at a critical juncture and that understanding its complexity requires assessing both the challenging financial fundamentals and the extreme technical market microstructure. The full material contains much more to explore regarding this unique market dynamic, particularly how long that ATM strategy can sustain the transition. We've discussed the strategic importance of CMCT's $31 million cash injection versus the structural challenges posed by its 1-for-250 reverse split and 60% short float. Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks.
Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights. And see you in the next video.